Hello everybody and welcome to this lecture video on the accounting cycle. And we are going to carry on our lecture today with accounting cycle steps 6 and 7. So where we left off last time was accounting cycle step 5, which was adjusting entries. And to refresh your memory on what adjusting entries are, is they are entries that are required anytime there is a timing difference between accounting periods when the cash is received or paid in one period, but the expense or revenue may occur in a different time period. Okay, and there are 4 different types of adjusting entries. I prepared a video for you guys in week 3 for prepaid expenses, and we also lectured on some of those in class, which were supplies and long-term assets. I left a video in week 3 on unearned revenues. And then in the pre-class assignment, I had included some need-to-know videos on accrued expenses and accrued revenues. Those were provided by the publisher, and I thought they did a pretty good job of explaining and kind of walking you through the process. So I didn't make my own videos on that, but hopefully with those resources between the videos I provided, the in-class lecture, and the need-to-know videos, you can get a pretty good idea of adjusting entries. So if you have any questions on those, you can go back and check those out. But once all of those entries are recorded and posted to the ledger, as you'll notice here, we don't really have a separate step for posting adjusting entries to the ledger like we do here in steps 2 and 3, but just know that that needs to happen. Once you record your adjusting entries, you also post those to the ledgers. And then you move on to step 6, which is what we call the adjusted trial balance. Now, we've heard that term trial balance before. We've prepared one in step 4. But that first trial balance that we prepare in step 4 is called unadjusted because it does not include all of the adjustments we had to make for those timing differences. Okay, so really the trial balance that we had in step 4 is incorrect. Okay, so now we need to update it with the correct numbers that include, like I said, all of those timing differences, the revenues and expenses that we hadn't previously captured in the unadjusted trial balance. So your adjusted trial balance, again, says here, after all adjusting entries are recorded and posted to the ledger. And the format is just like the unadjusted trial balance, which means it's going to be a list of all of the accounts that the company has, and it's going to include the balances from the ledgers in the appropriate column, either debit or credit. And then the sum of all the debits should equal the sum of all the credits. Again, that's a theme you're going to see over and over, is that balancing of many different things. And in this case, the trial balance, we want to balance our debits and credits. Okay, but there are going to be some major differences between the adjusted trial balance and the unadjusted trial balance. Okay, it's not necessarily in the format, it's in the numbers, because the numbers are going to be different in those adjusted accounts. So you're going to see changes in accounts such as receivables, supplies, prepayments, accumulated depreciation, unearned revenue. Oh, and I forgot one here. Let me add it in. Payables. Okay, so things like salaries payable and other things like that. You're going to see changes there. And in addition, you're going to see changes in the related revenue and expense accounts, right? Because that's the whole point of these adjusting entries, is that we missed some revenues and expenses when the cash changed hands at a different point in time. So it's going to be all of these assets and liability accounts that are going to change, as well as the revenues and expenses that are going to change. Okay. Now, once you have your adjusted trial balance, we can move on to step 7, which is the financial statements. And the financial statements are actually the end product, the deliverable, the thing that we have done all of these steps for is here in the financial statements. Okay, so I think I've showed you this slide a few times before, but this is the definition of accounting, and it's an information and measurement system that identifies, records, and communicates information about an organization's business activities. Well, the financial statements are this step here, step 3. This is how we communicate information to those people who need it, especially the external users, which are the investors and the creditors. Okay? Because if you think about it, a business on any given day, in any given month, in any given year, does so many things, right? Tons and tons of sales and expenses and cash going in and out every single day. And we've recorded all of that in detail in all of these steps, right? All of our journal entries and all of our ledgers and all of our adjusting entries. And there's so much information there. But the users of financial statements, the investors and creditors, they don't need to know all that detail. Okay? They want to see the information in a quick, concise format that they can easily read, easily look at, that communicates that information efficiently and clearly to them, okay, without having to deal with all of this detail that's in there, okay? So we use a very specific format to communicate, and that is the financial statements, okay? Now, there are really 3 primary financial statements, which are the income statement, the balance sheet, and the statement of cash flows. Now, you'll see that on my chart here, I have the income statement and the balance sheet, and I don't have the statement of cash flows, but I do have this statement of retained earnings. So let me first explain why. The statement of cash flows, which I don't have on here, is one that we're going to talk about in a later chapter. So I don't want to address it right now. It's kind of more advanced, so we'll get there eventually. Don't worry. But the 2 main financial statements we're going to talk about now are the income statement and the balance sheet. And these are the main statements because they give us most of the information that we need about a business. And then there's also this statement of retained earnings I have here in the middle. And the reason why is because this is kind of like a bridge statement. That's why I have the image here of a bridge. It's a bridge that helps to get us from the income statement to the balance sheet. Okay, it's not a primary statement. It's not one that provides a whole lot of information, but you can't prepare your balance sheet without it. So that's why it's in here as steps 1, 2, and 3. And this is the order that we prepare our financial statements in as well. The income statement is prepared first. The statement of retained earnings is prepared next because you need it in order to prepare step 3, which is the balance sheet. And all of these financial statements are interrelated, and that term we use to show how they're interrelated is called articulation. So let's get into how we actually prepare those financial statements. First of all, every financial statement has a header, consists of the company name, whichever that name is, so that we know which company we're looking at. The second thing in the header is the name of the financial statement. So if it's the income statement, we put income statement. If it's the balance sheet, we put balance sheet. And the last thing, and most important, is either the date or the period. And these are two very distinct concepts here, date versus period, and I'll explain why. So be sure to note that as I continue on with this lecture. Okay. So the first statement we need to prepare is what a statement called the income statement. And this statement is important because it answers that all important question, how much money did we make? Okay, that's what every business wants to know. So this income statement answers that question for us. Okay. I call it an activity statement because it tracks the company's activity over a period of time. Okay, so that's why I've got this guy running because it's something that the company did over a period of time. So we measure it for a period of time. So think about it like running a race, right? You time the race. It's for a period of time, whether that's, you know, minutes if you're running a short race or hours if you're running a marathon. But regardless, it's over a period of time. Okay, and the reason is because it's measuring activity or verbs, actions, right? Because the things that go into income are revenues minus expenses. So revenues is an action. It's selling, it's providing services. So we're measuring how much activity, how much we sold, how much we provided. Okay. And expenses. Expenses are all the things you used up, and using is a verb. Okay. It's an action, and you measure actions over a period of time. Okay. Now, that period of time could be a month. So it would say the date would be for the month of January, or it could be a year, which would be for the year ended December 31st, 2018. But it's going to be, you must indicate how long the period is, whether it's a month or a year. Okay. Yeah, I don't want to see one single date. I want to see the whole period. So I know if it's for a month or for a year. Okay. So the format of an income statement is revenues minus expenses equals net income. Okay, so we've talked about this formula before. It's how much money we make. And this statement, this income statement, really summarizes that for us in a quick and easy way. So let me show you what an income statement looks like. Okay, so what you see here, and this is also, I believe, on page 20 in your book if you want to ever reference this again. But what you see here is, again, that header, which has the name of the company, income statement, and then the period of time, and the period clearly indicates the month ended December 31st, 2017. Okay, so this tells us revenues first, right? And it lists out the detail of the different types of revenue. So this particular company has two types of revenue, consulting revenue and rental revenue. And it lists those out. And then it sums them up as total revenues. And this is the sum right here. Okay, now the book in this example is showing like two different columns. One column is for the detail and one column is for the subtotals. I'm not super picky about that, having those things in different columns. You could put the subtotals right underneath. I have no problem with that, but you know, this is just how the book is showing it to you. And so this tells us then the total revenues, everything they earned, all the services they provided during the month of December. And then here they have expenses. And expenses, again, they list out the detail. They used up rent and they used up salaries in order to generate this revenue. So they list out the detail here. And then the subtotal of total expenses is right here. So this tells us everything they used up in the month of December in order to generate this revenue. And then the net income is the difference between the two. The revenues minus expenses is the net income. So the answer to that question is how much money did we make in this period is this number right here. And like I said, the financial statements are set up in a way to communicate that information very quickly, very, very easily. So someone who's used to reading financial statements, if they want to know how much did the business make, they're going to look immediately down here on the bottom. Okay? And they're going to know, okay, that's how much money the business made. And we double underline it here to show that this is an important number. Okay, so come back for the next video and I'll explain the next financial statement.